Good day and welcome to the Harry Sale Wealth Show. Today, my guest is Jesse Merson. Not only is he a dynamic mortgage agent in Toronto and has helped countless families find their perfect home, but he's also a family man, an avid cyclist, and an all-around fantastic person. Jesse Merson, welcome to the show.
Thank you, Harry. It's an absolute pleasure to be here. Thank you so much. It's a privilege.
Of course, I'm happy to have you here. Why don't we give everybody who's watching just a bit about your background and journey in real estate and how you got to Vine Group?
Sure. So essentially started at a big bank right out of school and got into mortgages fairly quickly, actually, although my initial impression of mortgages was I didn't really want much to do with them. They were quite what seemed to be complex and a lot of work required in the background. But I quickly fell into mortgages very quickly. And I realized that it's actually amazing being part of that journey with a client. And so that was about 20 years ago, and worked my way through the bank, had various successes throughout that time, and eventually just got to a point in my business where I just needed to provide more options, have more thorough conversations with my clients. And so that's what led me to Vine. And that's where I am now. And it's been a great journey. I've enjoyed it. And it's nice to take things to the next level. So very happy to be with Vine.
Love to hear that. It's fantastic. And making the switch from a bank to an independent, maybe tell us a bit more about, impetus behind that and some of the biggest differences you've seen.
Sure. So there's so many differences, and I didn't realize it being at the bank for so long. I just didn't realize how large the mortgage market is in Canada. I didn't realize how many options there are outside of the bank. And I got to a point in my career at the bank where I was getting to a point in a conversation where I kind of knew I couldn't really bring to the table what my clients were looking for, whether it was just simply the product the bank didn't have or the client situation was something the bank was not interested in. And so unfortunately, I started to turn away some business or come to the table with solutions that weren't potentially the best option for the client. They were the best that I could bring to the table based on the product suite I had available and the rates I had available and, whatnot. But I started to realize there is a bigger world out there in terms of the options that are available and the ways that people can borrow money to buy a home or a second home or an investment property. And so it was a real eye-opener literally within the first few weeks of leaving the bank. I thought I knew everything about home finance, and I really only knew a very small portion of home finance. And so it's been a big eye-opener. And it's really sort of re-energized my whole thought process on, helping people buy property here in Canada. So it's been amazing, and I've thoroughly enjoyed it. And it's been, just frankly, fantastic.
Awesome to hear. That is fantastic. It's nice to have, both perspectives, being at a bank and being in an independent. So I'm sure you can bring expertise from both, but curious for anybody watching right now, what your impressions might be in real estate in terms of the country. I know you're obviously in Ontario, but maybe give us a bit of an overview of how you and your team see it, and maybe narrow it down to Ontario and maybe even the GTA, just to get specific.
Sure. So I think overall, the Canadian housing market is quite healthy. Yes, we've had some pullback from the most recent years in terms of home values. Obviously, rates were elevated significantly after the pandemic. I don't really think it's fair to compare where we are today or where we were before the pandemic to those 2021, 2022, or even the 2023 years. I think those were very much an anomaly. The entire world went through a situation that nobody in our recent lifetime had ever been through or could have been prepared for. And so it really is an anomaly. So anybody that locked in at, sub 2% during that time, I don't want to say it's maybe once in a lifetime, but it could potentially be a once in a lifetime opportunity. So we are, getting back to normal. I think overall, everywhere in Canada is a great place to live, get a job, raise a family. In terms of Ontario, where we are, obviously it's very heavily populated, extremely diverse workforce in terms of the different types of jobs that you can get here in Ontario, especially locally here in Toronto. I think there are maybe some short-term concerns over certain segments of the market. For example, the condo market, obviously, we had so many of them come on board the last 7 to 10 years that they've definitely taken a hit recently. But a lot of my younger clients, not even just my younger clients, but clients in general, are a lot more interested in condos now. The price level has come down. They're seeing it as an opportunity. And I mean, if you're going to buy a condo as an investment, you need to now, I think, instead of thinking, I'm going to flip this in a couple of years, really look at it as a long-term investment, whether it's for retirement or long-term cash flow. Also, I think cottage country has come back into fashion a little bit. Obviously, it blew up during the pandemic. We saw some crazy prices there. And again, a little bit of a pullback. It was ebbs and flows after the pandemic, but we had a lot of clients this summer get a lot more interested in second homes and whatnot. I think really what we need to see to get things really back to a super healthy level is just some consistency and stability. Because when you're looking to buy a home, you need some confidence that things are going to be at least the same, if not better, tomorrow to make that decision. And there's just so many things that have been happening. It's hard to decide, okay, I'm going to buy a new home when there's so much rate volatility, so much political volatility. You just want some stability in life so that you can make that purchase, do the right thing for your family. So I think overall, I'm super positive, especially if you have that long-term view. We're going to get to, higher price points eventually. That'll naturally happen with immigration and just other economic, development. If you're looking at flipping real estate or, some of the more short-term strategies, we're going to see some volatility there. There's no doubt. But, if you're looking to buy a home for yourself and your family, I think now is a great time. Prices have not pulled back as many people thought they would, considering how much rates jumped up over the past, year and a half, 2 years. They're starting to come down to a price point, or rates are coming down to a level now where you look at that with the price point that we are sitting at, and average home price has come down a little bit. Now is a really great time to, look at buying that home, I think.
Yeah, it kind of segues into my next question. The wanted to divide this into about 3 sections, first being prospective buyers. And one of the biggest questions that I get is, at what point should I be involving somebody like yourself? When is it too early? When is it too late? Or typically, when would you want to be a part of that discussion? So if somebody comes to me and says, hey, Harry, I'm looking to buy a house, at what point should somebody like yourself be involved?
Yeah, that's an amazing question. And I would say as soon as possible, quite frankly, because if you're going to make a major decision, whether it's buying a home for yourself or an investment or the second home, you want to know the lay of the land, all of your options, all of your potential options to make the best decision. And so as soon as you start thinking, okay, you know what, my family is growing, we want to buy a new house, or, there's a chance I'm going to get a new job and I'll be relocated. As soon as one of those life events happens, one of those triggers happen, I think you definitely want to find out what your financing options are. And I always tell my clients, look, one of the first questions your real estate agent is going to ask you is, what's your budget? Literally, one of their first or second questions will be, what's your budget? And so your budget for most people is made up of 2 things: your down payment, which could be your cash and savings on hand, or the equity in your current home that you're looking to sell, plus whatever you're looking to borrow. And so that's one of the things where, if you just go to one place and say, okay, I'd like a pre-approval, that's great. They're going to give you probably the best option that they can based on what they have to offer. Whereas, there are a multitude of lenders out there that will look at your financials in different ways. They have different lenses on, your income and your assets, and what, you could be incorporated, and they'll look at that versus, not just your traditional personal income. And so knowing all of your options and being able to weigh all of those to make the right decision is key. So as soon as possible, engage a mortgage professional, no doubt. Yeah.
Yeah, for sure. It's fantastic. It's one of the biggest questions I get. So happy to hear that. What prospective buyers often ask me are, should I go fixed? Should I go variable? I'm sure you get that literally every time you talk to somebody, but I also heard you speak briefly on a mix between variable and fixed within the same mortgage. So I'm just curious if you can give us a high overview of your opinion of all 3, variable, fixed, and the combination.
Totally. Well, that is such a fluid conversation that can literally change week to week, month to month, based on different things that are happening in the world. You know what I mean? For a very long time, for the past, I'd say 2 years, maybe a touch longer, the 3-year fixed term was hands down the number one choice for most people buying a home, renegotiating their mortgage renewal, etc., because it was a sweet spot where the rate was quite attractive, but you weren't locking yourself in for too long. Everybody thought that if we're in this declining rate environment, I'd rather have the option to renew my mortgage sooner via a 3-year fix versus being locked in for 5 years. I think right now the strategy a lot of people are looking at is a variable rate mortgage. The expectation is rates will come down, from today when we're filming this to next summer of anywhere from about 1 to 1.5%. And so I think most people would look at that forecast and go, I want to be a part of that. And so the variable rate term allows you to ride that rate wave down. One thing I would say if you are going variable is know your conversion options at the end of the day, because not every lender is the same in terms of what you're allowed to do if you want to convert out of a variable to a fixed rate, which you can do at any time. Most lenders allow you to do it without paying a fee or a breakage fee. Another interesting thing I've sort of recently started to think about, strictly based on some of the volatility south of the border and some of the policies that could potentially come into play, is right now, look at a 5-year fixed. I think the 5-year fixed will be back in, fashion. It was the number one choice for years, before the pandemic. I think it's an attractive option now because the rate is very good. It's very close to a 3-year, but you get an extra 2 years of protection. And so what that extra 2 years does is allows you to ride out the next presidential term. And so if you're looking at things happening in the US going, look, I don't really want any rate fluctuations. There's talk that variable could come down over the next little while and then potentially start to go up at the end of next year or early, 2026. And if that's something that's going to keep you up at night, definitely look at a fixed rate. And if you don't want to be renewing into, if you don't want to renew in 3 years when you're still going to have potentially the same president in the United States, maybe you look at a 5-year and just ride it all out. So I think that's an attractive thing to take a look at. But to your point about, the hybrid approach, I think it's amazing. Just like you would do with your clients and structure a diversified portfolio for their investments to mitigate, risks in the economy. You can take a fixed rate and a variable rate. Your fixed rate, of course, is, your hedge, your sort of safe harbor. But if you're looking to sort of really optimize any potential interest savings, then the variable, could be another great way to or segment for your funds. And it gives you the best of both worlds. So yeah, I think it's a great option that everybody should look at. And it could give you, sort of the best of both worlds.
That's huge. I actually didn't really know about it. You're one of the first people to have mentioned it to me. So I know that that's a fantastic option. Some of the new prospective buyers might be curious about taking advantage of the new longer amortizations of over 30 years. I'm just curious what you can say and what the pros and cons might be of extending the amortization from 25 to 30 for a prospective or for a new buyer.
Yeah. So the 30-year is great, I think, for the first-time home buyers. That's the recent change. If you're putting down less than 20%, you could only amortize up to 25 years. The extra 5 years to bring you to 30, it essentially does a number of things. So it can accomplish a few things depending on your priorities. The extra 5 years is equivalent to, so I've run the math on all kinds of things. It's equivalent to lowering your monthly payment by about 10%. So at 25 years, if your monthly payment was say $2,000 a month, that exact same mortgage scenario with a 30-year amortization, your payment's going to be around $1,800. Okay, so that's reasonable savings there. Or you could look at it and say, okay, I'm actually comfortable at a $2,000 a month payment, but I'm going to extend to 30 years, which allows me to qualify for a bit more. Therefore, maybe I push my new home purchase price up that you need to do. So I think that's great as well. It also is roughly equivalent to, if you do the math on the, reduction in payment going from 25 to 30 years, it equates to roughly 0.9% in savings, interest rate savings. Everybody right now, you have to buy a home, you are qualifying your contract rate, your mortgage rate plus 2%. This extending to 30 years is almost like saying in a roundabout way, you're qualifying at your contract rate plus about 1.1%. So it eases things. Again, it's all depending on how you look at it, but it will allow you to either qualify for a bit more or at the end of the day, have a lower mortgage payment overall. And I don't think anybody should be scared of the 30-year amortization because there's so many levers you can pull throughout the life of your mortgage to actually bring the amortization down. So if today, a lot of people are looking at it going, I would love a 30-year am because yes, I would love the lowest possible payment. Perhaps fast forward a few years and your income has increased, the economy is doing a little bit better and you want to accelerate your mortgage payments, for example. That's an easy, quick thing that you can do to reduce your amortization by about 2.5 years on average, roughly, just by paying accelerated bi-weekly, lump sum payments as well. So if you get an annual bonus at work or you have some extra money saved up and you make a lump sum to your mortgage, these things can have a huge impact on not only the amount of interest you'll pay over the life of your mortgage, but how quickly you'll pay it off. I also think that where you are in your life stage is important, so if you are younger, don't be scared of a 30-year amortization. If you're perhaps 50, 55 and thinking about retiring in 10, 15, maybe 20 years, that is something that you kind of want to plan for. You may or may not want to carry that mortgage into retirement. So it's one of those things where, a mortgage professional is going to have that thorough conversation with you, probably in conjunction, with yourself, Perry, with that financial planning piece where, it all sort of works together because, the mortgage today is a financial tool in your portfolio overall. Back in the day when rates were, double digits, it was all about pay it off as soon as you can, get rid of the mortgage and you'd have a party. Now you can kind of use it to build your net worth over time, right? So again, it's just part of the planning piece overall.
No, that's excellent information. I know the decision can be difficult for a lot of people, so it's good to have both sides just to see pros and cons. We'll just move on to sort of the current homeowners, and I've had a lot of people who have a house at the moment, and they're really curious about, is now a good time to change the rate? Is it better to refinance now? Rates have come down. Should I switch from fixed to variable or the other way around? I'm just curious what you would sort of say to, anybody in Ontario looking to refinance their mortgage. What would you say for current homeowners at this time?
Yeah, so that's, I think, top of mind for a lot of people right now. And I think really it's case by case. I talk to many people throughout the day where it does make sense. They're paying above market interest rates. We figure out what the penalty is and we figure out what their interest costs would be. So we basically do a comparison between if you leave your mortgage as is, here's how much interest you're going to pay till the end of the term, versus if you were to break it, what your new mortgage would be, including the breakage fee, at the lower rate. What are your interest costs during that same time frame? And essentially, if the interest costs are less than the penalty, it makes sense. So I would say right now, if anybody's paying about 5.8% or higher on their mortgage and has about 1.5 to 2 years left, that is a prime candidate to look at refinancing. I have this really great tool where literally within a few seconds, I just need to know a few details about the mortgage. I can get a very good idea of what your breakage fee is going to be if you're at one of the big banks. And so, there's two types of penalties, 3 months interest or the interest rate differential. And just a lot of the way that the bank's posted rates are set up right now, a lot of terms are only a 3 months interest penalty to break. And so if you fall into that bucket, absolutely, I would say take 15, 20 minutes out of your day, speak to somebody who can run those numbers and show you the math. Refinancing can be done for a number of reasons. You may be looking to, and refinancing in my world is a term that we use if you're switching from one lender to another. It doesn't just necessarily mean you're breaking your mortgage and leveraging the equity in your home for a renovation or a kid's education or investing. We use that term when you're moving from one lender to another. And so that happens all the time too. There are so many, as you know, all the headlines, so many mortgages coming up for renewal. You definitely want to find out what your current lender is going to offer you, but find out what other options are there, because there's a lot of lenders that are hungry for your business. There's a lot of great promotions and there's a lot of great rates out there. So don't always just take your first offer, shop it around a little bit. And I think a lot of people would be surprised to find, what they have access to out there.
Yeah, no, it's fantastic. Definitely a ton of options. I'm glad that you kind of went over those. Some people have been asking me about using some of the home equity that they have to finance some renovations or expansions, or maybe even creating a rental unit in the basement or what have you. I'm just curious what you might recommend for a homeowner currently to use their home equity to finance either renovations or expansion or anything like that.
Yeah, I think if you need to renovate your home, your family's growing, or you're working from home now and you need more usable space in your home, typically, depending on your financial scenario, a mortgage or a secured line of credit is typically your lowest interest rate as it relates to borrowing, because of course it's secured against property. So the interest rates on offer are typically lower, and it can be a better option than pulling money out of investments, because if you've saved up, all that money for a specific reason and you're looking to then liquidate those investments, you could have capital gains exposure. You may throw off your plan for the future. And so, yeah, definitely. Looking to leverage the home equity to therefore, at the end of the day, essentially increase the value of your home by creating a secondary unit or, renovating to make your home better in one way or another, whether it's, underpinning your basement or, adding an extension at the back or whatever it happens to be. I mean, that is value that at the end of the day, you're not going to necessarily recoup $1 on that, but it's different spending money on that than going on a 4-month vacation to Hawaii. Different use of funds.
100%. That tons of sense there. Yeah, I mean, it's really good to hear. There's a lot of people who have a current house at the moment. What they want to do is either unlock some of the value there, or maybe they're a retiree and they're saying, I am house rich and investment or cash poor. I'm really curious about how you might say to somebody who is a long-term homeowner who has essentially paid off their house and they have maybe put tons of their money into it. How might they be able to use some of that home equity to help with any of their retirement income, or essentially just unlock the value of their house to pay for things in retirement?
Sure. Yeah. So I've helped a number of retirees, not only, once they're in retirement, but also leading up to it. And I think one sort of tip I would say to anybody thinking about retirement is, while you are earning your income, which is most likely when you're working, going to be greater than your retirement income, that's when you should go in and get a secured line of credit on your home, or, maybe refinance your mortgage and get the money that you need while you have the income to support it. Because as soon as you retire and you are now on a retirement income, whether it's pension or investment, CPP, OAS, all that stuff, typically you're not going to have the same earnings power. And so really income is one of the primary drivers of what everybody qualifies for. So the more income you can show, the more you will qualify for. So if you're leading up to retirement, even if you don't think you need it now, go in and get a line of credit, because at some point something's going to come up where you're going to need it, whether, it's making your house more accessible because there's a health issue, or helping a grandkid or your own kids, or travel becomes, something that you want to do and you don't necessarily want to sell your home and downsize, which is, another option as well. There are options for that. So you can get a home equity line of credit, put that in place. If you don't use it, you don't pay for it, but you've got it for whatever, life throws at you down the line. Once you are in retirement, again, it's all about your income. There are programs as well that will allow you to qualify based on income and a combination of your investments. Not a lot of people know this. I find that a lot of people are surprised when I say, okay, your income qualifies for this, but your investments, actually, we can push up what you qualify for a little bit. We don't collateralize the assets or anything like that. It just helps you qualify for a bit more. But yeah, you can leverage your home equity and use it for all kinds of things. Mortgages, I think, if we want to talk about that a little bit, can be a powerful tool. The product, when it first came out, maybe 10 years ago, a little bit longer than that, it was quite expensive. It was a little restrictive. And really, that was due to there only being one company that kind of offered these products. Over the years, more players have entered the market. More companies offering the same product has created competition. So right now, a lot of these reverse mortgages you can set up and you don't pay any legal fees. The provider will eat those fees. The rates aren't too bad. They are typically maybe about 1.5% higher roughly than, a 5-year fixed mortgage rate. I think more importantly though, they're super easy to qualify for. You just have to have home equity, be 55 plus, not owe the CRA a tremendous amount of money. And you have some flexibility in terms of how you take that money. You could take it all at once as a lump sum. You could have it paid to you as an income over a certain period of time. You can pay the interest that's due every month or not pay the interest. You can let that accrue. And it's very similar to a mortgage where you pick a term and at the end of the term, you decide what you want to do. I find a lot of the clients that I know that use reverse mortgages, it accomplishes two things that you can't really put a price on. One, it buys some time. So if you don't want to sell your house now, to your point, but at some point in the future, you're going to have to downsize for whatever reason, you can get some funds out of your home to maintain your lifestyle for the time being. So that's amazing. And I think it also alleviates a lot of stress. So buying time and alleviating stress because it's easy to get and buys you that time to stay in your home and make some maybe, decisions that you don't want to necessarily make at the snap of a finger and take time. I think it's a great product to consider. Again, not for everybody, but they they are around for a reason and they do make sense for certain scenarios, 100%.
Yeah, no, for sure. I'm happy that you can shed a bit of light on that. I know that's certainly something that's on people's minds is how to unlock the value. Really, before I pass it back to you in terms of things that you might say to us in general about trends you're seeing, questions you often get, or things that we haven't really talked about today, one of the biggest questions I get are, what's the difference between, the green bank or the red bank or the blue bank? And I've seen in lots of places where some have fixed pay and variable rate, some have variable pay, especially in different scenarios with different providers. I just wanted to give a sense of what you've seen from different banks and what you might be able to tell us. What is really the difference between banks and what could be the difference between them and independents and what you see in the structure of how they put together their mortgages?
Yeah, so at a base level, they offer very similar products. But once you do some digging in terms of some of the features and options that are available, I think I sort of mentioned before, if you have a variable closed mortgage and you want to convert to a fixed rate term, conversion options are not the same at all banks. So some banks will allow you to, at any point in time, switch to a 3, 4, or 5-year fixed rate term. Some allow you to switch to a 4 or 5-year fixed rate term. Some only allow you to convert to a fixed rate term that is greater in length than what you have remaining in the variable. So those are some of the more restrictive terms. So that's something that I think is very important, because if all you're doing is comparing the interest rate and you go with somewhere that's a little more restrictive versus somewhere that gives you, maybe the rate's slightly higher, but better conversion options at the end of the day, that could potentially save you a lot of money. And so a lot of people just simply get caught up on the interest rate and not really do a deep dive into, okay, well, yes is a great rate today, but is this still going to work for me 2, 3, 4 years down the road? And so again, that's where I think, on the broker side, I can really sort of say, here are all the different, and there's less bias, because at the end of the day, I'm just presenting options from a multitude of lenders and not just coming to the table with one product from one lender. And I know their features inside and out, and I can talk all day long about how great they are, but I'm not going to tell you about what the other guys do because I don't work there and I don't really know anything about them. So that's a good one. I mean, there's a lot of different options. The way that lenders calculate penalties or breakage fees can vary from bank to bank. To your point about variable rate mortgages, some lenders will adjust your payment as the rate goes down. If rate goes up, of course, your payment would go up. So, in this interest rate environment where we expect rates to come down over the next, whatever it is, 10 months or whatever, a lot of people are looking at that going, well, I want my payment to come down every time the Bank of Canada drops their interest rate. Not everybody does, but a lot of people kind of like that flexibility. There's even lenders out there that will leave your payment static. And if the rate does go down, you just call them and they will reduce it. So it's not an automatic reduction, but you at least have the option in your back pocket later down the line, which is amazing. A lot of the bigger banks do have static payments. So regardless of what the rate does, your payment stays the same. It's the internal ratio of principal and interest that will fluctuate. And so back when rates increase so much, so quickly, all of a sudden the term trigger rate became something everybody was talking about. And up until like 21, that was in nobody's vocabulary. It was never talked about because rates were so stable. And so these are just some of the things that you just want somebody who knows all the ins and outs and can sort of say, okay, well, yes, that does sound like a great option, but here's what that means, versus here's this one where, here's what that means. So, you just definitely want to get a good sense of, and I always tell my clients, I'm like, listen, we want to make sure this works for you today, but I also want you to be very happy with this, like I say, 2, 3, 4 years down the line. And I think that's, super important.
Brilliant. Really good to hear, Jesse. Just in terms of some wrap-up thoughts before we drop off today, curious what you would say to Canadians for 2025, some advice that you might want to give people, any sort of thoughts for new home buyers, or anybody who might want to look in 2025. What would you be telling Canadians to kind of prepare for, or any thoughts that you just have in general?
I would say definitely be prepared for some volatility. It seems like, the last couple of months or so, headline will come out and change the trajectory of what everybody thinks is going to happen going forward. And so I think really the best way to alleviate some of that stress in terms of all that volatility that we will no doubt experience, I would imagine. Have that conversation early, get some planning in place so that when you do ultimately find that dream home or that perfect home and you want to put an offer in, you've got a lot of confidence that, this is the right decision. I would also say for anybody that has a mortgage up for renewal, start that conversation really early, because I've noticed a few things change in the last 6 to 8 months that we never really used to see. In years past, if you have a mortgage up for renewal, you would hear from your current lender 4 to 6 months in advance saying, you do have the option to renew now without a penalty, lock in the rate today. With rates being so volatile, I'm finding a lot of lenders aren't really approaching their clients until the very last minute. And then that kind of leaves you stuck because you can't shop around. If you've got less than 30 days to renewal, good luck trying to get an application approved, funded, and at your lawyer for closing on time. Lenders are bombarded and slower than they were before. And so, if you have a mortgage up for renewal, 4 months beforehand, get an approval in place. You're not locked in or obligated to anything. Just get approved. And as you approach that closing date, that's when, someone like myself, a mortgage professional, will come to you and say, okay, look, we're about 3 weeks out. Let's take a look at the best terms and rates. And then you can make a decision and you're not stuck with your current lender. Not that that's a bad thing, but at least you have another option in your back pocket. Yeah, planning and timing is key because you don't want to be shuffling around last minute because it most likely isn't going to work out in your favor if that's the case. So yeah, just try and get ahead of things timing wise would be my biggest suggestion for 2025.
No, that's fantastic. I know, the 4 months ahead for everybody listening here. Make sure you're talking to somebody like Jesse at Vine Group to get your homework done before it's too late. So Jesse, I really appreciate the time today. Thank you very much for the insights. I know everybody watching will get tremendous value from it. And of course, for anybody watching here, Jesse Merson is at Vine Group and is certainly happy to chat with you when or if you have any mortgage questions.
Absolutely. Thank you, Harry.